Hey guys, welcome back. Today order flow and delta, how to see the real buying and selling pressure hiding inside every single candle. Here is the whole idea in one picture. Every candle you have ever seen is really a fight between two groups, buyers lifting the ask and sellers hitting the bid. So let's open one up and split it into prices. On the left, in red, is the volume that traded on the bid, aggressive sellers. On the right, in green, the volume on the ask, aggressive buyers. Add up both sides and you get the delta ask minus bid. Positive delta, buyers won the candle. Negative, sellers won. That one number tells you who was actually in control, which price alone can never show you. Now watch a real fight. First, red delta, candle falls, sellers in charge. Then the selling gets heavier, an even bigger red delta, price drops hard. And right here is the moment that matters. The sellers keep hitting just as hard. The volume is huge. But the candle stops going down. A bigger buyer steps in and soaks up every share they throw at it. That is absorption. And look at the delta. It flips green, even though sellers were still swinging. From there, delta flips green again, price turns up, and the buyers take control. The sellers never stopped selling. They just ran into someone bigger. That is what order flow lets you see, and the rest of this video is how to trade it. Here is the routine, 4 steps, and the fourth keeps you out of the trap that catches everyone. Clean diagram first. Step 1, red delta, not just price. On every candle, ask volume minus bid. Volume tells you who actually won it. An up candle with green delta is real buying. But an up candle with red delta, price ticked up while sellers were dumping, that is a warning the move is fake. Step 2, spot absorption. You are watching for one thing, heavy aggression slamming into a level, the volume enormous, and yet the price will not move, and then the delta flips. That means a bigger player sat there and soaked up everything the crowd threw at the level. When sellers swing that hard and price holds, the next move is up, toward the one who absorbed them. Step 3, spot exhaustion. The opposite tell. Price grinds to a new high, but the delta is shrinking. Each new push has fewer aggressive buyers behind it than the last. Price up, delta down. That divergence is the move running out of gas, and that new high is bait. Step 4, trade the flip and skip the fake. You enter when delta confirms the flip at an absorption low or the divergence at an exhaustion high. Your stop goes beyond the extreme. Your target is the prior swing. And here is the rule that saves your account. A giant volume bar whose delta does not flip is not absorption. It is distribution. A big player handing shares to the crowd. Volume tells you how many traded. Delta tells you who won. Never confuse the two. Rid delta, spot absorption, spot exhaustion, and only trade the confirmed flip. Now let's run it on 3 real charts and 1 trap with our 3 traders. Meet the 3 traders taking every one of these setups, each starting with $10,000. First, this is Mike. He reads the delta, waits for the absorption flip or the exhaustion divergence, and trades with the flow. Next, this is Jake. He trades price only. He shorts the scary candle, buys the new high, and calls every big volume bar absorption. And finally, this is Tom. He waits until the move is obvious on price, by which point the order flow is already spent. Same charts. The only difference is whether they rid the delta. Trade 1, absorption. This is the real Uber chart from late November, and I've put the delta proxy right under the candles so you can see who won each day. The stock has been sliding, and then one brutal red day. A huge selling thrust, the biggest red delta on the chart. Price gaps lower and everyone is sure it is going to 40. The very next session price pokes us a fresh low, even lower than the panic day. But watch what it does into the close. It closes right back at the top of its range. Sellers hit it just as hard, the volume was massive, and the candle would not stay down. On the strip, the delta flips green. That is absorption. A bigger buyer sat at that low and ate every share. Jake never looks at the strip. The big red day convinces him the floor is gone, so he shorts the scary candle, no stop. Mike waits one day to be sure the low holds, then buys the flip. His stop just beyond the absorption low, his target the prior swing high. The day after he is in, price is already squeezing, and Jake gets squeezed out for a loss almost exactly where Mike bought. From there it just climbs. The move finally looks safe to Tom near the top of the range, so he pays up late for a small scrap. And a few days later Uber tags the prior swing target. The absorber paid Mike 2 to 1. While the trader who read the same candle by price alone paid to be wrong. After Uber, the gap is already clear. Mike read the delta flip and bought the absorption, while Jake shorted the exact same candle because price was all he looked at. One chart, $1,700 apart. Trade 2. The same signal on a different stock, so you know it is a pattern and not luck. This is Disney on earnings. The report misses and the stock gaps down hard. A wall of red delta, a true panic day. The next session price actually prints an even lower low. By price alone, it looks like the bleeding is just getting worse. But look at the delta strip again. That lower low candle closes green and the delta flips positive. The buyers quietly ate the entire morning of selling. Jake shorts the breakdown. The down candle tells him down, and that is all he needs. Mike sees it instantly lower low, green delta absorption. He takes the flip the next day, stop just below that low, target back toward the gap, and the bounce runs Jake over almost immediately. He is stopped right where Mike entered, the same trap as the first chart. Tom waits for green to be obvious and pays up for a thin slice near the top, and a few sessions later Disney tags the target, another clean 2-to-1 for reading who actually won the candle when the price said the opposite. 2 for 2. The same absorption signal on a completely different stock paid Mike again, which is how you know it is a real edge and not one lucky chart. Jake has now shorted 2 bottoms in a row. Trade 3. The other side of the coin, Exhaustion. This is Coinbase in May, and this time we are hunting a top. First comes a powerful green push, a strong day, big green delta, real buyers in control. Then price grinds to a slightly higher high. But look at the strip, the delta is smaller than the push before it. The next day, one last poke to a marginal new high, and the delta is smaller still. Price up, delta down, 3 pushes in a row. That is divergence. Each new high has fewer aggressive buyers behind it. The move is running on fumes. Jake sees a fresh high and buys it because new highs feel safe. Mike does the opposite. The divergence is his signal, so he shorts the rollover, stop above the exhaustion high, target the base below. Price rolls over on Jake within days and stops him out. Tom waits until the drop is undeniable and shorts it late for a small piece, and Coinbase slides all the way to the base, target. The divergence pays 2-to-1 again. A new high with shrinking delta is not strength. It is the last buyers walking through the door. 3 for 3, and this one was a top, not a bottom. Absorption finds the floors, Exhaustion fades the ceilings, and the same one number reads both. Jake has bought a top to go with his 2 bottoms. Now the trap, and it is the most expensive mistake in order flow. This is ServiceNow, and it looks exactly like the 2 winners you just saw. The stock has been rolling over from its highs, and then it happens, a monster candle, 55 million shares, by far the biggest volume on the entire chart. It gaps down, stabs a deep low, and closes well off that low. A giant hammer right at the low. Every absorption rule you just learned screams BUY. And Jake does. He buys it big the next morning, his largest position yet. Certain a bottom that violent has to hold. But Mike checks the one thing, Jake skips the delta. And on that monster candle, the delta barely moves. It is only just positive. 55 million shares changed hands and yet almost nobody won. Which means it was not one big buyer absorbing the sellers. It was a big holder quietly handing shares to the crowd on huge volume, while price looked like it bottomed. That is distribution wearing an absorption mask. So Mike refuses it. No flip, no trade. And the chart proves him right. There is no follow through. The very next sessions it just keeps falling, through the hammer low like it was never there, down toward 100. Jake holds sure the bottom is in, and finally dumps it in disgust near the lows for the worst loss of the 4. Tom, for once, is saved by his own delay and stays out. This is the rule that protects your account. Volume tells you how many shares traded. Delta tells you who won. A giant candle whose delta is barely positive was not absorbed. It was handed to the crowd, and Mike skipping it was the best trade in this video. Here is the whole run on one screen. Every candle, read by all 3 traders. Mike took 3 trades and banked all 3. The absorption flip on the first chart paid him, the divergence on the second paid him, and the freshest red on the third paid him again. $3,000 just from asking who actually won each candle. And the trade that mattered most was the one he refused, the biggest volume bar in the whole video, the one that looked exactly like a bottom. It was the trap. Tom made a little. He saw the same charts, but he always paid late. Entering after the flip was already spent, so being right bought him crumbs, and Jake lost on all 4, almost 40% of his account gone. He read every candle by price alone and never once asked who actually won it. The charts were not the problem, ignoring the delta was. Same candles, 3 endings. Price tells you where. Delta decides everything else. So here is your whole order flow playbook on one screen. 1. Rid delta, not just price. Ask volume minus bid volume tells you actually won every candle, and a green move on red delta is a fake. 2. Absorption is the flip when heavy volume slams a level, price refuses to move, and the delta flips. A bigger player absorbed the crowd, reverse toward them. 3. Exhaustion is the divergence. A new high on shrinking delta means the move is out of fuel, so fade it. 4. Trade the confirmed flip and skip the fakie. Enter on the flip, stop beyond the extreme, target the prior swing, and never buy a giant volume bar whose delta does not flip, because that is distribution, not absorption. Price tells you where the market is. Delta tells you who is winning. Trade with the side that is actually winning. That is the entire edge. That is order flow and delta. the buying and selling pressure hiding inside every candle. Read the delta, wait for the absorption flip or the exhaustion divergence, and never confuse a big volume bar with a real one. Next up in this series, tape reading and the order book, how to watch the bids and offers update live and read the intentions behind them in real time. Subscribe so you don't miss it, and drop a comment with the ticker you want broken down next. See you in the next one.